But moving on to some macro data then, inflation in the US has risen more than expected, coming in at 3.5% on a year-on-year basis. Core CPI, which excludes the volatile food and energy prices, has risen even faster at 3.8% compared to March 2023. Now, this data comes in higher than what economists and experts were expecting, making investors wary of rate cuts in the future, which Goldman Sachs sees in July now rather than June. Now, this inflation data, remember, is still above the Federal Reserve's target of 2%. So, we also caught up with market experts, in fact, on how this is likely to impact the Fed's decision as well as investor sentiment. Listen in to what they had to say as well.
Well, I think it will be, because the Fed will be very mindful of not giving a signal that they are about to cut rates when the oil price is going up or the headline inflation itself is rising. When the rates went near zero, the debt profile changed a lot. The liability of businesses, of consumers changed a lot. So if this duration were extended and the refinancing of that coming end of this year, beginning of next year, Fed will have to take that into account. So they will then, in that case, they will not wait, and you will see rate cuts down the line toward the end of the year, because so far rates have gone up, but that has not hit many businesses and consumers because the debt profile had longer duration. And that is something that Fed has to really worry about. And then you will see Fed cutting rates even if inflation was at 3 or where it is today, because you will have really a weakness coming down in the economy.
A stronger US economy coupled with cut interest rates ahead could mean that the asset allocation by a lot of global funds would veer towards the US market itself, and then you also have the competing recovery that is happening in the European markets as well. So India per se facing these odds, which is the election odds, the better economic output or better economic outlook, both Europe and US, could mean that the days for Indian markets are going to be a little better. Days for Indian markets are going to be a little bit numbered. We are at peak valuations as I speak with you, but the only solace that we have is that these peak valuations are getting supported by our own economic strength and rising corporate earnings. So it remains to be seen how these asset allocations happen going forward, but the outlook seems a little worrying as far as India is concerned.
All right, well, that was the word coming in from the experts, but a day after hotter than expected US inflation data, Uday Kotak, the founder and non-executive director at Kotak Mahindra Bank as well, issued a warning about prolonged higher interest rates worldwide, including in India. Now, Kotak emphasized the potential for global turbulence, citing China's economic situation as a wild card. Speaking on X, formerly Twitter, the ace banker also highlighted these concerns, urging readiness for potential economic upheaval as well. So that was a word coming in from Uday Kotak. But tell you what,
if you like this video, then like, share and subscribe to ET Now.